Yeah. So if all you have in your debt structure is a common equity piece, right? And maybe you have a mezzanine, or maybe you're just a common equity. And this is most of the cases, you have senior debt and common equity, right? And what typically happens is this maybe the sponsor's two scenarios, right? The sponsor needs to bring in a big capital piece, a large capital piece, but that large capital piece is like, hey, I don't want to be treated by all the other people that are investing 100,000 because I'm bringing in 5 or 3 million, right? So I want to be in a preferred position. Where are those rights spelled out to that larger investor? Traditionally, if you look in the PPMs, sometimes it'll say we allow side letters. The sponsor can just create a side agreement with this other investor and give them this preferred position, this better split, this whatever it is, to try and get them to come in. And oftentimes side letters are used for that. Or if you have the property in an LLC and you're thinking that you're actually investing directly, the property is being bought by that LLC and you're actually investing directly in an LLC, to get around side letters, what preferred equity people are saying is, no, we're going to create another LLC and we're going to joint venture with you where we have real ownership and you have real ownership, but we have the right to take over. And so oftentimes common equity guys don't even realize that they don't actually have, the manager doesn't have control over the asset. It's a tangled web. But in all of those cases, there's some side agreement or like a JV agreement, co-management agreement, oftentimes isn't disclosed. And you want to ask these questions. And oftentimes it happens at the very last minute. Sponsors worried about losing their $1 million of hard-earned money, or somebody pulls out, and they have these kind of sharks have a lot more leverage.